Everything is changing for retirees, and not in a good way. Most people are completely unprepared for how new government policies could reshape their retirement. Trade policies are making everyday items more expensive, tax law changes could take away key retirement strategies, and on top of that, Social Security and Medicare reform could cut into benefits just when retirees need them most. I've spent years helping clients navigate uncertain economic conditions, and if there's one thing I know for sure, it's that reacting after the rules changed is often too late. So that's why in today's video, I'm going to break down 3 major government policy shifts that could directly impact your retirement, and more importantly, what you can do right now to protect yourself. So let's dive in. As I'm sure many of you have noticed, quite a lot has changed over the last couple of months. And I think the problem with today's retirement landscape is that what worked maybe even just a couple of years ago could now be putting your entire retirement at risk due to these potential policy changes. So the first thing we want to talk about is trade policy and interest rates. We currently have a president who calls himself a tariff man, and I know how sensitive everybody is these days about talking politics. I have no interest in going down that path, but I do have interest about how trade policy and interest rates can potentially impact retirees. So we're going to focus on that. And the first thing I'm going to say is tariffs are not going to impact retirees in a good way. So the first thing is they are almost certainly going to increase prices. It's a tax. It's just common sense that they're going to be passed on. Now, some economists may say, oh, this will just be a one-time hit. But the problem with that is that inflation is all about expectations. And so if the cost of all of these goods rise, workers might go and say, I need more money. It's exactly what happened in 2022 and just especially for the whole period after COVID. And so this could continue that. And even if these are just one-time price increases, if workers keep asking for more, inflation is going to go up. If wage expectations keep rising, this could lead to stagflation, which is the worst scenario for retirees. This means that if you have a fixed retirement income, it's going to eat away at your purchasing power. Also, it's a terrible environment for investment assets in general. If you looked at the 1970s, last time we had a real period of stagflation, both stocks and bonds did really, really terribly. So it was one of the worst times ever to retire. The second policy change is that the Trump administration wants a weaker dollar. I think the key in understanding how that's going to impact you as a retiree is focusing on the word weaker. The reality is, no matter how you want to talk about exports and this and that, a weaker dollar means you will be poorer. It's just a simple fact. And so that means that your purchasing power, once again, is reduced. No matter what we do from a trade policy, the U.S. cannot just exist on its own and not have trade partners. There are certain critical components that we need to import. And if the dollar is weaker, that just makes those more expensive. And so this is going to make it harder to maintain a stable retirement budget. The Fed is in a really difficult position right now because inflation is real and trade policy could actually cause inflation to go up. Now, at the same time, GDP growth might actually go down, and in normal circumstances, the Fed might actually lower interest rates, but they're in a position where they probably can't do that. What's happened for, maybe the last 20 years or so is that every time that the markets have been destabilized because of a recession or some type of financial crisis, the Fed has come to the rescue, and the Fed has provided trillions of dollars of liquidity, and they've propped up asset prices. At this point, it's very debatable how much room they actually have to be able to do that. So if you're a retiree, you really do need to concern yourself with potential blowups on your portfolio, and you can't necessarily expect the Federal Reserve to just come to your rescue anymore like you could before. And so look, with no clear policy direction for interest rates, markets could swing sharply, and that could really make traditional kind of set it and forget it strategies a lot riskier than they were previously. Now, I'm sure this might have surprised you as these are pretty recent shifts, and since there's so much information there on what the best way to handle them is, I want to make sure that your retirement isn't negatively impacted by this. So if you're concerned that this might be impacting you, Click on the first link in the description where you can complete a 2-minute questionnaire, and I'll send you a personalized video where I'll give you tailored advice based on your situation. Now, back to the video and the second policy change, and this is tax policy. So we're looking at a situation here where you've got potential restrictions on Roth conversions and limits on tax advantages for large retirement accounts. So what's going on behind the scenes is that lawmakers are eyeing Roth conversions as a source of tax revenue, and they're arguing that high-income earners are exploiting loopholes like the backdoor Roth and the mega backdoor Roth, and it's helping them shield large sums from future taxation. And so what's been proposed is eliminating backdoor Roth IRAs, and they're going to prevent after-tax contributions from being converted into Roth IRAs. Something else that's being considered is having income limits on Roth conversions. Currently, anybody can convert to a Roth, but new rules could actually restrict higher earners from doing a Roth conversion. And so you probably know, Roth conversions are one of the best tools for managing taxes in retirement. And so losing this option probably means bigger future tax bills when you're retired at, kind of the worst time. Something else being floated is that they want to have new RMD rules for high balance accounts. So that means if you have a really high balance IRA or 401k with several $1,000,000 in it, they're going to force you into having faster withdrawals through RMDs, and that's going to make an even bigger impact on your taxes. The last potential policy change is entitlement reform, and specifically changes to Social Security and Medicare. So I'm sure that you are aware that both Social Security and Medicare are completely unsustainable at their current levels. The Social Security Trust Fund is projected to be depleted by 2033. So what that means is that without reform, benefits are going to have to be cut by 20 to 25%. They're debating on how to fix this now, but here's some ideas that are being floated out there. One idea is raising the full retirement age from 67 to 69, which basically means it's going to reduce your lifetime benefits. Another idea being floated is means testing for Social Security, which means higher earners could actually receive reduced benefits, or they could be phased out entirely. Something else I've seen floated is payroll tax increases. So they could raise Social Security taxes from 6.2% to 7.4%. And they could also raise the cap on, there's an earnings cap that's currently about $168,000, and they could raise that to an even higher amount. Something else they've talked about is reducing the cost of living adjustment. So if you're a retiree, these kinds of changes matter a lot. First of all, if they raise the full retirement age or they cut benefits disproportionately, that's going to impact those who plan to retire early or anybody who really is going to rely heavily on Social Security. If means testing is implemented, that means higher income retirees are going to need to figure out alternative income sources to replace their lost benefits. And finally, if they reduce the cost of living adjustments, that means you're going to have to figure out other ways to maintain your purchasing power. And now with Medicare, I'm also, just like Social Security, in a lot of trouble. So Medicare's Hospital Insurance Trust Fund is projected to be insolvent by 2031. So what this means is that the income-related monthly adjustment amount could kick in at lower thresholds for higher earners, and that could be a big impact on retirees. They've also discussed pushing the eligibility age from 65 to 67, and there might even be increased cost sharing and increased deductibles. So that means just retirees with only, kind of moderate to high incomes might pay significantly more for Medicare coverage while they're retired. And it also means you might have higher out-of-pocket medical expenses, and you're going to just have to budget more. And it's going to force retirees to rethink their spending and saving strategies. So with all these changes coming, you got rising costs from trade policies, tax laws making retirement plans trickier, and potential cuts to Social Security and Medicare. You might be wondering, well, what can I actually do about this? And so I think the good news is you don't have to overhaul your entire retirement plan, but you do need to make a few key adjustments to stay ahead of these shifts. So now we're going to go over exactly how to do this. So I think the first shift is going to be diversify beyond just saving in your tax deferred, like pre-tax 401k account. I know they're great, and if you're a high earner, there's a lot of benefit to it. But because they're talking about making all these changes, having this kind of optionality of having savings in different buckets is really going to benefit you and enable you to kind of be very tactical about whatever changes might come down the pike. So something to do here, right, is consider doing Roth conversions now, right? Even if you're a high earner, that might mean just doing like, $5,000 or something, but get them started at this point. If you have a Roth 401k available, I suggest using part of that. One thing that I do with a lot of my clients that have a Roth 401k available, we kind of split how much they're contributing to pre-tax and then the after-tax Roth IRA. So it doesn't have to be all or none because, some of these guys are kind of high earners, and so taxes do take a bite, but maybe they're contributing 10 grand to the Roth and then 13,500 to the pre-tax, just as an example. Something else to consider, do backdoor Roth conversions now if you have that option available to you. Not everybody does, but look into your plan and see if that's an option. And last, consider saving in a regular taxable brokerage account. And that's going to help you with all of these kind of tax strategies. In the end, especially through retirement, you'll be able to pick and choose which bucket works best for you every year instead of being stuck just only withdrawing from your IRA or 401k or whatever it is. Now, with the potential Medicare changes, I think having an HSA becomes all the more important. So number 2, if you have the ability to do so, strongly consider saving in an HSA. I think probably the only reason you wouldn't want to do this is if you have a lot of ongoing healthcare expenses and you really do spend a lot because you have regular chronic healthcare conditions. Otherwise, having an HSA account is going to be a great way to mitigate any future Medicare reductions when you're retired. Savings that goes into HSAs, it's triple tax advantage. That means they're tax deductible, they grow tax free, and withdrawals for healthcare expenses are also tax free. My advice to you is start one of these accounts now and then delay spending from them and invest the funds instead. I would want to use this as something that I can spend in retirement, and I would just spend out of pocket for my regular expenses now. Of course, depending on your situation, right? But in general, this is going to be a great way for you to get ahead of potential Medicare cuts. Number 3, and this goes back to trade policy and interest rate uncertainty, this is shift away from long-term government bonds. While they do pay a little more now, and sometimes long-term government bonds do well in market panics, they don't always. And if inflation ticks back up and long-term government bonds are only paying about 4%, in real terms, when you adjust for inflation, you're not going to actually earn any money. On top of that, if inflation really does kick up and continue to trend up, you'll actually lose money on these long-term government bonds. And I talked about it earlier, the 70s are a great example of this. So I would replace long-term government bonds with things that are way less sensitive to rising interest rates and inflation. So look for inflation-resistant strategies. You might consider Treasury inflation-protected securities. There are certain types of dividend stocks that tend to do pretty well during rising inflation. Commodity type strategies also do well in this type of environment. Number 4, the big thing a lot of people are worried about lately is the impact with trade policy and interest rate uncertainty on their retirement portfolio. So number 4, you're going to want to protect against market volatility and a shifting world order. We are in a situation that is kind of unprecedented. It might go back to like the 1930s with all of the protectionism going on. And so the US starts trade protection, and then Europe does, and all the countries around the world. And like I said, the last time we saw that was the 1930s, and that ended up being pretty terrible for financial markets. So the first thing to do to protect your portfolio is diversify. And I think for the longest time, diversification has been kind of stupid, and I've been a pretty big critic of it too, and a lot of people are way too diversified, and to the point that it's actually really costly. But I do want to focus in on a couple areas that I think you might benefit from. So one, you probably do want to start owning some international stocks right now. I've made fun of market strategists for years. They've been pounding the table, oh, own more international, own more international. And their reason was, well, it's cheap. But it's been cheap for a long time, and it can be cheap for a reason. But now things, I think, are starting to finally change. You've seen a big pickup in momentum overseas, and I think Europe finally understands that they are going to have to go at it alone, and they're going to actually have to start spending. Second, use momentum strategies. So momentum investing is basically, in simple terms, seeing what's done well lately over maybe 6 to 12 months, investing in that, and don't owning the losers that have done poorly. One very simple way to improve your investing results is simply stay away from losers. And you don't have to be a stock picker here. I'm talking about broad asset classes or maybe even sectors. So shifting more to the sectors that have done well and shifting away from the ones that have done poorly. I even do that with fixed income. There's a ton of evidence that goes back decades on momentum investing. It's something that can be exploited across sectors, different countries, and different asset classes. But why incorporating strategies like this into your portfolio matter? Well, these tend to do really well during periods of high inflation and big changes in market dynamics. And so I think everybody would benefit from having strategies like that in their portfolio. Finally, we want to add some type of downside protection. There's a couple of ways I'll discuss here. The first one is advanced, and the second one is a more simple method that I think, even somebody that's relatively inexperienced at investing could do. But let's talk with the advanced way first. So there's something called tail risk hedging. It's something I'm big into, and it's something we've spent considerable resources on executing. So in its simplest form, tail risk hedging means that you're buying portfolio crash insurance, and you're going to spend a very small amount of your portfolio, call it 1% to 2%, and you're going to buy crash insurance on the stock market. And then if the market gets into a huge sell-off like the global financial crisis or something like COVID, you're going to get a huge return, just like if you were buying homeowners insurance and your house burned down. During the global financial crisis or even during COVID, strategy like this were often up 1,000% or more. So you can do the simple math and think, well, gosh, if I had 1.5% of my portfolio in that, well, now all of a sudden that becomes, 15, maybe even 20% buffer there. And it's going to allow you to sell that down and then buy stocks when they're cheap. And it will also allow you to not take some kind of catastrophic loss, because sometimes historically, markets really do take a long time to recover. If you went back to the Depression, it took like 15 years. And so as I mentioned earlier, the Fed might not be able to come to the rescue to the extent that they previously have over the last 15 or 20 years, and that might mean a prolonged bear market. Now, the simpler thing that almost anybody could do if you're really worried about risk is use something like a bucket strategy. And that might mean reducing some of your stock exposure, and then you have buckets. You'll have short-term buckets that, probably invested in cash or T-bills. That's going to meet your needs for the next year, maybe 2 years. Then you have something in intermediate term that you could access, and, that might be another 2 to 3 years of withdrawals from your portfolio. And then last, you'll have things in a long-term growth-oriented bucket that hopefully you won't have to touch, because your first two buckets should be able to get you through, most longer term type bear markets. So look, I know that it's a little bit scary out there right now and there's a ton of uncertainty, but I hope that now that you see there's actually some things that you can do to help get ahead of any major policy changes that are going to come down the pike, you can still have a successful retirement. And if you're looking for more help with this, I've put together an entirely free retirement questionnaire that'll give you more personalized insights about your retirement readiness. It walks you through the same kind of process that I use with my clients. And at the end of it, you'll get a video from me personally kind of guiding you through the next steps towards planning a successful retirement. Just click on the link in the description below to get started with that. Thanks for watching, and I'll see you next time.